Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today we're going to talk about the Fed meeting. So on March 19th, the Fed had their meeting, well, on the 18th and 19th, but, they do their announcement on the 19th, and then that's followed by a press conference with Jerome Powell. And I got to say, this was a very anticipated meeting. For those of us in the mortgage business that are watching very closely as to what the Fed is thinking about, frankly, all the chaos that's going on in the world around us, right? We have so much talk of tariffs. There's been a lot of mixed data on employment and inflation and all the things that are going to impact mortgage interest rates. It was really going to be interesting to see how he navigated through this meeting, really in the midst of all of these things kind of happening in real time. And look, it could have went, in my opinion, one of two ways, right? I mean, Jerome Powell could have come out and been very hawkish with the increased inflation numbers that we've seen of late. Now, they're not significant, but we have seen inflation start inching up a little bit. And we all know that, with their dual mandate, right, their mandate of keeping inflation in check, keeping things affordable for the consumers of the United States, but also, maximum employment, if you will, right? Those are really their dual mandates. And we have movement happening on both of them. So I was very relieved, let's just say, that he didn't come out with as hawkish of a position that he could have. I mean, he could have come out and said, look, inflation's starting to come back up. We need to be really aggressive on that. They could have reduced the number of anticipated rate cuts that they were going to see in 2025, which they did not do. They left that at 2 rate cuts in 2025, 2 more rate cuts in 2025. Now, how that ends up unfolding, or if that ends up transpiring, time will tell. We're very much in a wait and see kind of a situation. But let's talk about what he did say and what I heard him pick up on, because there was some, good news, I feel like, for the mortgage industry. Not as good as it could have been, and I'll get to that in a second. But obviously he acknowledged that there has been increased inflation readings as of late, right? We saw that with CPI, and then we don't have the PCE numbers at the time of this recording. I think they come out later this week. So, this is March 25th. And so we'll have, what that PCE looks like when this recording drops. But, let's just talk about that for a second. I was watching a pretty thorough analysis that Barry Habib did on what they're expecting the PCE number to come in at. And they're expecting it to stay flat, if not actually go down a little bit, where it's widely anticipated that PCE is going to be up. And they did a very thorough review of kind of the logic behind that, and it made very sound sense to me. So, this could be very positive for us if we see PCE come in below expectation and, not showing year over year inflation growth. But that's not what's expected by the market. And so this is going to be huge. And as you guys may remember, that is the Fed's favorite measure of inflation is PCE, which will be coming out here in a couple days. But nonetheless, he did acknowledge that there is inflation pressure. Now, he talked about it primarily probably being because of the tariff talks, and that in anticipation of some of these tariffs, we may have already seen companies raising their prices, or, some tariffs, are already in effect. Although in a pretty minor way at this point. It's really not until April 2nd where we get these reciprocal tariffs that things could get kind of crazy. And there's a lot of unknowns about what's going to happen as we get closer and closer to April 2nd. But he definitely mentioned the tariffs as probably one of the main reasons why we're seeing a little bit of inflation edge up. But the other thing they did say is that longer term, they do not expect inflation to run rampant. They did raise their expectation a little bit for where they expect inflation to be at the end of 25 and 26. But by 2027, back down towards their target 2% number. So if you look at their kind of forward-looking trajectory, I think what this implies is that any inflation that we do see because of tariffs, they're expecting to be transitory. And, I'd say that word with a little bit of tongue in cheek because remember last time we talked about transitory inflation was during COVID and they got that one very, very wrong, right? I mean, they said inflation was transitory. Next thing you know, we're at 9% inflation. And that came up, as you would imagine, in the Q&A afterwards. And he said, look, we're nowhere in a similar situation to that. We do expect any inflation that is due to tariffs would be transitory. And it makes sense, right? Because when you think about tariffs, it's like a one-time thing, right? Inflation, you got to remember, it's not the price of goods necessarily, right? I mean, look, all the inflation we've had over the last couple of years, it's still in effect, which is why people are like, man, grocery prices are still really high. All this stuff is really high. Yeah, inflation moderating is not going to bring down the existing price of things. It's just going to slow the increase moving forward if we get to their 2% target number. So all the previous inflation is still there and we're still building from there. And that's something that I think a lot of people forget when you think about inflation. But if you think about how tariffs would impact inflation, it's a one-time thing. You get a 25% tariff on certain, goods or services or whatever they may be. That goes into effect and then it's there. And then, as you move forward, you would notice that inflation during that time that it happened, but it wouldn't continue to increase because of that tariff. And I think the Fed was acknowledging that. Now, the other area, obviously, that he spoke about was employment. And this is an area where he really walked a tightrope, in my opinion. His favorite word is strong, right? The employment is strong. He said strong like 18 times in this press conference. But look, as much as he was saying that the jobs and employment situation are strong and healthy and so on and so forth, they did increase their projection from where they were in December up to 4.4% unemployment at the end of 2025. And that's, in my opinion, that's it's good for two reasons. One, they've acknowledged that employment is going to be a little bit weaker. But two, now we have a line in the sand, right? We have this 4.4 number that if we get close to that or above that, we can expect them to take action. And there's reason to believe that that number could get above 4.4. And I'll talk about that in just a second. But then they expect their the unemployment in 2006, 2007 to be 4.3. So still elevated from current levels. So, as you look at this picture, what we have here is a situation where they're expecting GDP to be slow. They're expecting inflation to be moderate, although a little bit up, and they're expecting jobs growth to not be as strong, despite him saying the word strong so many times. And that picture is hard not to think about stagflation, right? And there was lots of talk if you were, I watched the press release live and then I watched some of the commentary afterwards. And there was a lot of talk about this kind of sounds like stagflation. I did not hear Jerome Powell say that, stagflation, but look, that's what it is, right? If the cost of goods keep going up, if GDP is low and unemployment starts going up, but yet costs are still getting more expensive, like that's stagflation. And so it was kind of, woven throughout this conversation without actually saying those words. Now, I think there was one question in the Q&A about stagflation. And, you think back to the 70s where stagflation was out of control. And I think that he did kind of try to minimize that even if there is stagflation, like, circumstances going on, that it's nothing like what we dealt with back in the 70s and tried to paint that picture. Now, I listen to a lot of different, podcasts and conversations about what's going on with the economy. And one of the conversations was also from Barry Habib, who was doing his morning update. It was actually just this morning. And he mentioned that he had a conversation with Lacey Hunt, who he's mentioned in the past, one of the top economists in the country. And I wanted to give you a couple of the things that he mentioned that Lacey had mentioned in their conversation. One, he sees the 10-year getting to 3.8. Right now, the 10-year is still, I think it's over 4.2. So it's come down from its highs, but expect that at 3.8, which would be great for us and mortgage rates. He expects unemployment in 2025 to peak at 4.7. So that's really interesting when you think that the Fed's number is 4.4. Lacey Hunt saying 4.7. Barry did comment that, their estimate's around 4.4. But if Lacey's right and we see unemployment get up, like I said, if we get close to that 4.4 and it happens relatively quickly, and then we start going past that, the Fed's going to have to take more aggressive action because they've already drawn that line in the sand on where they expect employment to be. That's why that was so big for them to choose a number that's, it's elevated. It shows that they know what's going on, but it's also low enough that I think we could see unemployment exceed that with everything that's going on. And if that happens, it's going to give the Fed reason to move, especially if inflation is still in check, which I'm a little bit more optimistic that we're not going to see significant inflation because I'm still, and you've heard me talk about this so much, I'm still pretty convinced that we will see gas and oil prices continue to come down, which they already are. And as that happens, I just think the inflation numbers are going to come down with it. So despite the tariffs and some of the other things that might be putting pressure on inflation, I still am of the belief that we will see very tame inflation as we move forward. And I think that the administration is going to do everything in their power to try to keep inflation low because that's really what they ran on. And they're going to try to do that. The other thing that Lacey Hunt had mentioned that Barry shared in this conversation was that part of the reason why we've seen yields on bonds go up recently is because of the German stimulus. Now, I don't know much about that, but it sounds like there is some outside influences from Europe that are pushing up our yields and that is temporary, and we should see that pressure ease as well. And then the last thing that he said, which I couldn't agree with more, is that, Scott Bessent, who is the new Treasury Secretary, is 100% committed to lowering the 10-year. We've talked about this in the past. We know that this is what the Trump administration has asked for. That's what he's asked Scott Bessent to do, and that's what he's going to do. And basically what Lacey said is, going against Scott Bessent and the idea that the 10-year is going to come down would be a risk. If you're an investor and you're going to bank against that, that's a risk. So what that tells me is that he's confident that Scott Bessent will be successful in his attempts to bring down the 10-year. You guys, all of this is good for the direction of mortgage rates. Now, does this mean it's going to happen overnight? Absolutely not. We got a lot of unknowns and uncertainty going on right now, but this is why I'm optimistic. All of these things, in my opinion, the whole Fed meeting, I thought was, it wasn't like the big pivot we saw back in September where it was like this huge change in anything, but it's all moving in the right direction, albeit kind of slowly. Now, part of what the Fed also announced, which was huge, is that they were going to slow the roll-off of their balance sheet by 50%. So they were going to reduce the roll-off of the balance sheet by 50%. So that's really good because what they're saying is that they're not going to take everything that rolls off and then push that back into the market. They're not going to flood the market with these additional treasuries as they get paid off. And so the good news about that is it's going to lower the amount of supply, and that's going to help stabilize the prices. Now, what he did say, though, is they were not going to slow the roll-off of the mortgage-backed securities. Now, in his announcement at the very beginning, he didn't say mortgage-backed securities specifically. So I thought that's what I gained from the statement that he read, but I wasn't 100% sure. But I got absolute clarity towards the end of the Q&A when one of the reporters had asked him specifically, do you see the Fed slowing their roll-off of mortgage-backed security holdings? And he said, we do not see that. We do not see that in the near future. It's not part of our strategy. We don't want to hold this much MBS. And he didn't say, that it couldn't happen, but it's certainly not part of the plan right now. And I'll be honest with you, I was listening to the announcement. I was watching the MBS market live, and it was up about 31 basis points at the time. And literally when that question was asked, it dropped down to about plus 18. So there was a market reaction to that one question. And it was the one that I was kind of waiting for. I almost now wish it wouldn't have been asked because he was so certain about not slowing the roll-off of MBS. But look, guys, if the Fed wanted to have an impact on mortgage rates directly, they could stop the roll-off of MBS, and that would have an immediate and significant impact to yields and to rates. And they don't have any interest in doing that. They clarified that. That didn't help us any. That was about the only part of the news conference that I was like, ouch, that was not what I wanted to hear. But they are gonna slow down the roll off of the 10 years, and that'll be helpful, right? It's just less supply into the bond market as a whole, and I think it was a good move. And as much as he tried to act like in the Q&A that it's not really a part of their monetary policy, they just think it's smart to slowly roll this off, slowly slow this. I think to me, it shows that they have concerns, and so anyways, that was an interesting part of the conversation. So lastly, just in finalization here, we got to keep an eye on stagflation. I think that's a big concern of everybody. It was the undertone, in my opinion, of this whole conversation. It's hard to say GDP is going to be down, employment's going to go up. Unemployment's going to go up and prices are still rising and not have that sound like stagflation. So we got to keep a close eye on that. Tariffs are very much a wait and see. And when I say wait and see, I think, if you guys remember a couple of years ago, it was the May 10th meeting that we were really waiting for. I think, there's a meeting on May 7th. And I think that the May 7th meeting, not that anything big is going to happen on May 7th. I'm not predicting that. I just think that by then, we should have a lot more clarity on what the impact is of the reciprocal tariffs that we're going to see implemented on April 2nd. We'll have, 2 more PCE reads and CPI reads by that point. We'll have, employment numbers that would be coming out that week. And so I just think we'll have a lot more information by May. But I feel like this meeting was moving us in the right direction. Basically, what this tells me is I'm still confident that we're going to see rates steadily improve. As I mentioned on my last podcast, I would not be surprised to see see something happen in 2025 that creates an acceleration of that. I mean, I don't know what it would be, but there's so much going on. It's very possible that we see something happen in the economy or just geopolitically that has rates improve. And look, you've seen massive hits to the stock market. You've seen, all sorts of things going on, all of which, would tell you we should be heading towards lower rates if inflation stays in check. So that's the big one. So we got to get through these tariffs and we got to see what the direct impact is on inflation. And by then we'll have more, we'll see more impact, I think, of oil and gas prices coming down. So it's going to be interesting. We still have the shelter component that we know is still improving, which is a big part of both CPI and PCE. So I'm feeling good. That's the bottom line. I'm feeling good. Not great. Not like this was amazing, but we're moving in the right direction. And look, I think it's important that we keep a close eye on this stuff and what's going on. It's so important to what we do as mortgage and real estate professionals to kind of know what's going on. That's why I bring this. I'm sure many of you that are geeks about this stuff, you probably watched the announcement just like I did and came to your own conclusions. For those of you that don't pay that close of attention, I appreciate you tuning into Market Shares to get at least my take on it. There's lots of places you could get information like this. I hope that you enjoy my perspective and how we tie it into specifically what it means for mortgage and real estate professionals. So with that, you guys, thank you for your time and attention today. Thank you for continuing to, let people know about Market Shares and what we're doing. And if you're not already subscribed, please do that. It definitely helps out the channel. And look, we just want more people to, organically find this channel when they're out looking for different content about mortgage. So anything you could do there would be helpful. And until next time, take care.